The worst time to explain your agency's EBITDA addbacks is after the buyer asks for them. Because at that point, you're not preparing anymore, you're defending. And when you're defending your numbers during buyer due diligence, you're already in a weaker position. A buyer looks at your P&L and asks, what was the expenses? Why did the margins drop? Why did profit spike one year and fall the next? What part of this EBITDA is real? And if your answer is, I think that was a one-time, or I'd have to go back and check, or my bookkeeper may know, that's a problem. Because buyers do not pay premium valuations for confusion, they pay for clarity, they pay for clean numbers, they pay for confidence. And today, I want to show you how agency owners can start building that confidence before the LOI ever shows up. Hi, I'm Craig Cody, I'm a CPA, and at Craig Cody & Company, we help marketing and PR agency owners keep more of what they make through proactive tax planning, better cash flow planning, and cleaner financial systems. In this video, we're talking about a mistake that can cost agency owners real money when they prepare to sell. Waiting too long to build the EBITDA addback story. This topic was inspired by Carl Sakis's article, Exit Your Agency Faster, 17 Fixes to Sell Sooner. You'll find the link to that article in the notes. Carl makes a point that every agency owner needs to take seriously. Buyers are going to recast your EBITDA. That means they are going to adjust your earnings to figure out what the agency is really producing. Not what your tax return says, not what your gut says, and not what you hope the number would be. They want to know the real earning power of the agency. And if you can't explain your addbacks clearly, the buyer may discount your number. They may push back for tougher deal terms. They may lose confidence altogether. So let's break this down. First, what is an EBITDA addback? In simple terms, an addback is usually an expense that reduced profit on your books, but may not reflect the normal ongoing performance of the agency. An example could be a one-time legal fee, a major recruiting expense tied to an unusual hire, technology migration that will not happen again, a temporary contractor cost tied to a short-term delivery problem, a large write-off in a specific quarter, a special consulting project that was necessarily once but is not part of normal operations. There are also a host of other addbacks that we talk about, such as the Augusta rule or many other tax planning strategies. These things will happen in real agencies, and the problem is not the expense, the problem is poor documentation. Because when a buyer is reviewing 3 years of financials, they are not just looking at the numbers, they're looking for risk, and unexplained numbers look risky. Here is actually where many agencies get themselves into trouble. They wait until they are thinking about selling, then they call their accountant, then they call their bookkeeper, then they start pulling reports together, and then they try to remember what happened 18 months ago or 24 months ago or 3 years ago. And that's what I call the EBITDA addback scramble. And it starts way too late. By then, you're trying to recreate history. You're looking through old invoices, old emails, old project notes, old bank transactions, and the buyer may be waiting. That does not instill confidence. A better answer is, yes, that was a one-time expense. Here's the invoice, or here's the reason for it. This is why it happened, and this is why it won't repeat. And here's how EBITDA looks after that adjustment. And that is a totally different conversation to have. That sounds prepared, that sounds professional, and that sounds like an owner who knows the numbers. And that matters because buyers are not just buying your agency gross income. They're buying confidence in the financial story. They want to know, is the agency profitable? Are the margins real? Is the revenue predictable? Are expenses properly classified? Are one-time items clearly documented? Can the owner explain those financial hiccups? And that last question is a big one because almost every agency has hiccups. Maybe agency gross income dropped one year. Maybe gross margin tightened. Maybe people costs jumped. Maybe you wrote off a bad client balance. Or maybe you invested in a new system, such as AI. Maybe you hired ahead of growth and profit took a temporary hit. None of those things will automatically kill a deal, but vague explanations will. If you say that was just a weird year, that doesn't help you either. If you say something like, we had a temporary margin drop in Q2 because we added delivery capacity ahead of 2 new clients we were about to sign, and those clients started in Q3, and margins normalized by Q4. Now you are telling a financial story, and that's what buyers want to hear. They want the numbers, but they also want the explanation behind the numbers. And that's why agency owners should not wait until exit planning to clean this up. You should be building your addback file every month. And here's the simple process. Each month, when you review your P&L, ask, is there anything here that a future buyer would need to have explained? If yes, document it. Not next year because you won't remember. Not during tax season because way too busy. Not during tax season, not when the LOI arrives. Do it now and do it every month. Create a simple Addback folder or spreadsheet. For every unusual item, track the date, the amount, the vendor, the category, why it happened, whether it's recurring or non-recurring. Or make sure your books are organized in a way that when you look at them with your CPA, it's easy to pull that item out and you know what that item is. That's the way we handle it. You want the supporting invoice and you want the business explanation. And that may sound basic, but basic discipline compounds. 12 months from now, you will not be guessing. 3 years from now, you will not be scrambling. And when diligence starts, you'll have a clean record of things that happened. Now let's talk a little bit about accrual accounting. Carl Sakis points out that buyers want to see accrual accounting, not just cash basis accounting. And this is especially important for marketing and PR agencies because agency cash flow and agency performance are not always the same thing. You may invoice a client before the work is fully delivered. You may collect the deposit today on a project that runs for several months. You may have retainers, you may have contractors tied to client work, you may have media production or other pass-through costs. If you're only looking at cash basis reports, the timing can distort the story. A strong buyer wants to understand how revenue matches delivery. They want to know what it actually costs to produce their work. They want to see gross margin. They want to see agency gross income. They want to understand overhead. They want to know whether EBITDA is sustainable. And that's hard to prove if the books are messy and not kept on the accrual basis of accounting. And the piece that makes it even harder, if your accounting is not built for an agency. This is where agency-specific accounting matters. A generalist accountant may prepare a technically correct P&L, but technically correct is not always strategically useful. For an agency owner, the financials need to answer better questions. How much agency gross income are we producing? Which clients are profitable? Which service lines are dragging margins down? Are contractors being classified correctly? Are people costs in line with AGI? Are we reviewing the right numbers monthly? Are we doing tax planning before the year end? And if a buyer looked at this tomorrow, would the story make sense? That is the standard, not just are the books done, but can the books support the value of the agency? A big difference. Now, before we keep going, let me ask you something. If a buyer asked you today for 3 years of EBITDA adjustments, would you be ready? Would you have the documentation? Would you have the explanations? Would your financials tell a clean story? Comment below, let us know, ready or not ready, and be honest, because if the answer is not ready, that's not a failure. It's a signal. It means you have work to do before the buyer is in the room, and that work is much easier to do now than during diligence. The biggest point I want you to take away is this: exit readiness is not an event, it's a habit. It's a monthly financial review, it's clean books, it's tracking unusual expenses. It's explaining financial hiccups when they happen. It's understanding your margins, and it's knowing your agency gross income. It's proactive tax planning. It's building the financial discipline before there's pressure. And here's the good news. Even if you never sell your agency, this work will still pay off because clean financials help you run a better agency. You catch your profit leak sooner. You make better hiring decisions. You price your retainers more intelligently. You understand client profitability. You improve cash flow forecasting. You avoid surprises at tax time, and you make decisions based on facts, not feelings. That's what you want, not panic accounting, not tax season cleanup, not let me get back to you financial management. Real visibility, month by month. If you're running a marketing or PR agency doing $1 million to $10 million in agency gross income with 10 to 50 employees, this matters because at that size, the business is too complex to manage casually. You have payroll, you have contractors, you have retainers, you have projects, you have tax planning opportunities, you may have remote employees, you may have client concentration risk, and someday, whether you sell or not, someone may ask, what is this agency really worth? Your answer should not start with a scramble. It should start with clean numbers. So let's recap here. Number one, do not wait until the LOI to build your EBITDA add-back story. That's too late. Number two, Buyers are going to recast your EBITDA, so you need to document one-time and unusual expenses before diligence starts. Number 3, vague explanations weaken trust. Clear documentation protects your value. Number 4, accrual accounting matters because buyers want to see how revenue matches delivery. And number 5, this is not just about selling, it's about running a more profitable, more valuable, more financially disciplined agency now. At Cody & Company, this is exactly why we work with agency owners throughout the year, not just at tax time. We help marketing and PR agency owners build better financial visibility, proactive tax strategies, cash flow planning, and cleaner numbers that support better decisions. Because your CPA should not just be recording history, they should be helping you prepare for what is ahead. So if you are thinking about selling your agency in the next 3 to 5 years, or you simply want to run your agency like a buyer may look at it someday, feel free to reach out. We can help you look at your numbers, identify planning opportunities, and start building the financial clarity your agency needs. And if this video helped you, subscribe to the channel. All right, before you go, if you're an agency owner and you want to keep more of what you make, I've got 2 things for you. First, grab a copy of my book, The 12 Biggest Tax Mistakes That Cost Agency Owners Thousands. It breaks down the exact mistakes I see every day and how to avoid them. Second, if you want to see what this looks like for your business, get a free tax analysis. We'll take a look at what you're doing now and show you where you might be overpaying. And if this video helped you, make sure you subscribe so you don't miss future strategies on tax planning, cash flow, and building a more profitable agency. I'll see you in the next video.